Hey Marion, can you hear me? Just want to make sure the mic is working. I think it should be.
Yes, I can hear you.
Okay, perfect. How are you doing?
Very well, thank you.
That's good.
I've sent the link to Miriam and Fumi, so I think they'll be joining in a minute.
Yeah, sure. No worries. There's no rush. Yeah, I don't know if you had a question. I know you wanted to cover some stuff today, but if there's anything specific, just let me know and we'll cover what
Okay.
you need help with. I
Yes,
think oh, go ahead.
sorry.
Yeah, go ahead. I was just gonna say, I think the main thing that you wanted to cover was some examples. If there's
Yes.
anything else, that's perfectly fine too.
Yes. Okay. So the questions I have, they're very, very basic. So I'll just hold on just a second. Miriam is saying she hasn't seen my message. Just a second, please.
Oh, no worries. Yeah, you can get them in the room and then we'll get started.
Okay, hold on just a second. Let me go back to my Discord and tell them what to do.
Okay.
Where is my
Okay, Miriam. Miriam is in.
Hi, I'm in.
Oh, okay, so Fumi is in as well. Fantastic.
Hey guys. Okay, it
Hi,
looks like
Sean.
everybody's here. How are you guys doing? Long time no talk.
Not too
It's
bad.
been a
How are
while.
you?
Doing
Yeah,
great. Doing great.
good. Good. Okay, Marion, you can go ahead.
Okay, so I was just saying that I was just telling Sean before you came on that I have a few questions, but my questions are really, really basic. So you guys will have to excuse me. But as soon as I'm done asking Sean my questions, then the floor is open for you guys to have your own discussion. And I think I will just pick up as you are going along. I'll be learning as well. So my first question is that, Sean, I know that when you're just before the market opens, you set your support and resistance levels for different time frames. I think you usually do the 4 hours,
Yes,
the
that's correct. Yeah,
15 minutes, the 1 minute. So I have two questions. Um, the first one is that sometimes when you pick your support and resistance levels, I sometimes wonder why you picked those particular points and not other points. So I just want to know, what do you look for to pick? Because, in any given chart, there are a lot of supports and a lot of resistance. And if we pick every one, the chart is going to be too cluttered. So how do you know which one to pick and which one not to pick?
yeah. So typically, what I choose when I'm identifying support and resistance is I'll look for the resistance. I'll look at the higher highs. So I typically go from the 4 hour. I'll start at the 4 hour because the higher the time frame, the stronger. So this is going to be set at 6:30 a.m. I typically will go to the 4 hour first, and this is like every morning. So every morning I go on live session, and then this is the first thing I'll do. I'll mark up the higher high, which is going to be this level right here.
Okay.
I pretty much ignore like the lower highs. They're good zones too, but the higher highs, they typically establish where the ceiling is. So higher high, you can see over here, there's a higher high, and you can see this is the top, and price continues to drop down lower. So this is a stronger resistance point. Same with this one up here. If you wanted to identify something higher, same thing with this. So you'll see this higher high, it kind of establishes like the ceiling. And from this point, this is how you know that this is going to be a stronger resistance. In the opposite, I'll be looking for lower lows for the support. So higher highs for resistance, and then lower lows for support. And I only mark up the ones that have not been tested. So for example, here, this one is the new lower low. You can see there's another lower low next to it right here, but it hasn't been retested. So like, for example, I wouldn't mark up this one down here because it's already been used, which it can be used again in the future if you want to mark this up as, you know, previous support. But for the most part, I keep it as is. And once I go down from the 4 hour, I'll drop down to the 1 hour. I only draw support resistance on the 1 hour and 4 hour, but I go from top to bottom. So I'll go from higher time frame down to the lower one. So I go down to the 1 hour, and then right here you can see again I'm looking at the higher highs only. So higher highs and lower lows. The lower lows over here are already lined up with the 4 hour time frame. So with this here, you know, I'll just label this as 4 hour support level. And I leave that alone because the higher the time frame, the better. And if they line up together, even better, even a stronger support there. And then lastly, I will mark up this one right here because this one's closer. So this one right here, same thing. I will mark this up as the 1 hour resistance level. And then if you want to have something higher, you don't always have to, but if you want to, you can always go to the next level. So this is the first level, and this is the next one right above it.
Okay.
And again, I'm just looking at higher highs and lower lows. Same thing here. I will mark this up as the 1 hour resistance level. And then same with this upper level up here. This is the 4 hour. You can see the 4 hour lines up with the 1 hour.
Yes.
And this will be the 4 hour resistance level. So once you have that marked up, then I go down to the 1 minute time frame where we trade on. And you can see how clean it looks when you have it marked up like that there. So you know what's important and you know what's not important. If you want to go on the lower time frames, you can always do that. But you have to keep in mind that, you know, these lower time frames are not going to be very strong. So if you want to mark it up on lower time frames, you can. But like you said earlier, you don't want to have too much markups on the chart, because the more markups, the more confusing. So you just want to focus on like what's important and what's not. And if you were to move forward from this here, you'll see how price respects these price points a lot better versus you know, the lower ones, because they typically stand. And then, for example, there, now this becomes from support, now it's now resistance. And you can see how price kind of just sits along this area. And if you're continuing to follow, there is another lower low right there. And then you can see how it kind of just it balances out, and you can kind of see where these levels are being established. So like now this level is going to be the 1 minute resistance, or 1 minute support actually. And then this support level becomes now 4 hour resistance. And you can see how price kind of just goes back and forth between this level here. Yeah, so that's how I draw it. I mean, you can do it differently, but I think the 4 hour and the 1 hour are probably the stronger time frames if you're going to be trading on the 1 minute. Obviously, if you're trading on a higher time frame, then you might want to use the daily or something higher. It just depends on like which level or which time frame you're trading on specifically.
Okay, thank you so much. And then my next question is also something you do just before. Well, actually, you do it throughout the session. I know you always check news, and so I don't know how news impacts, what kind of news impacts retail sentiment, either positively. What kind of news are we looking out for actually? Because there are a lot of things on that, yes, on this a lot of things come up here. This one, yes.
Yeah, so for this here, they all have somewhat of an effect, but you want to focus mainly on the high impact. So the high impact that are red and orange, or high impact or medium, these are typically going to be the news events that will have bigger movement. So like, for example, you can see over here at 5:30, there was some medium news. And if we go back to, 5:30 over here, let's see where the 5:30 candle is. The 5:30 candle is right here. So you'll see that, it wasn't high impact, so you don't really see a big movement. You see a movement, but it's not really a huge movement from this candle right here. So this here is the 5:30 candle, and you'll see that it was medium impact. So not really big movement there. And then there was more news over here at 7 o'clock, which was right over here. And you can see this candle is it's a little more erratic compared to the previous one. So you can see this one right here is actually a little bigger compared to the other candles that are previous. So you can see how manipulation kind of happens around those points. I mark up news for all of the news events, but the ones that you want to be careful for will typically be the orange and red ones. So those are the ones you want to be careful for, like not today, but yesterday, if you remember the market from Thursday and even on Wednesday, there was higher impact news. So pre-market, there was this big news event, 5:30. And if you go to the charts from that day, you'll see that it's a lot bigger. The movement was more extreme. It doesn't always happen that way, but you can see over here, it's pretty obvious. It's this big green candle right here.
Okay.
So you can see, usually when it's a high impact news, you'll start to pick up on like what's important. Typically, the important news will be like inflation news. So like CPI news, PPI news. On the first Friday of each month, it's going to be NFP. There's specific news events that will have like high impact, while others don't really have as much. So like PPI, you can see over here, we had PPI, core PPI, CPI, jobless claims. These are news events that will every month they'll come up, and these are going to be high impact. The one from today wasn't very crazy. It's Michigan consumer sentiment, and usually the news events that happen later on in the week are not going to be as effective as like the CPI news before, because this is just going to confirm what was already released on Tuesday, Wednesday, and Thursday, because those were the bigger news events. But basically, any news event that deals with inflation, interest rates, or the Fed, those are typically going to be the ones that will affect the market more heavily versus something like import-export prices, because it's something that happens every month, but people aren't really caring too much about this stuff versus something like, say, inflation.
Okay, so if the news is high impact and let's say it's inflation, how do you know when it's going to, the retail sentiment would be, how do I put it, a buy, if it's going to affect it positively or negatively? How do you know which direction trades are going to go based on a particular news, like inflation, for example?
Oh yeah, so looking at this candle over here from Thursday, so you just look and it'll usually be a certain color. So if we go back to the news event from yesterday, you can see over here that it's mixed, right? Depending on like which news event has a higher impact, they're about mixed for the most part. So you can see over here the news is mixed. So you can't really, there's no way to predict news. Like even though there's going to be negative or positive, like today wasn't a good example. I think Wednesday was a good example, because this is where the manipulation happens. This is why we don't trade news at all. So we don't even bother trading news, because you can see over here on Wednesday, all of the news is positive. It was positive with regard to news, but it's positive with regard to what they were expecting. So they're expecting the inflation news to be very bad, or not very bad, but worse than it was last month. But it was actually slightly positive. So you can see from here, this is Wednesday, and we'll go back to the Wednesday candle. So yeah, you can see right here, it was a crazy candle here, because it shouldn't have dropped like this, because the news was actually positive. So this is why, like, it goes back to saying, this is why I don't trade news at all, because it doesn't matter if the news is positive. The news was positive all around right here on Wednesday, but you can see
Yeah.
the still drop
Yeah.
quite a bit.
Okay.
Yeah, it dropped like 300 points. So typically, like, you would want to see, you don't want to trade news by itself, but you want to trade the reaction to the news. I think that's
Okay.
the main thing. So, like, for example, here, this drop. Now, what you would want to look for is possibly the correction, because you're going to expect price to push back up because the news was positive. And if you just follow it, eventually it's going to climb back up. It's not going to climb up super smoothly, but eventually throughout the day, it typically will correct back up. And you can see right here, it's making that swing back up right here.
Yeah. Yeah. Okay, thank you. So my next one is, what do you mean when you say liquidity?
Liquidity is liquidity is like typically where a lot of traders are placing their stop loss. So that's where the market's liquid. So for
Okay.
example, here I'll just I mean, there's different ways to market liquidity. The way that I market liquidity is, so like when the market opens, let's see. Okay, so I'm going to market liquidity from today. So let's go over here to 6:30. So what I'll do here is I'll go on I start with the daily and I mark up areas of liquidity. So they're areas of liquidity because that's where people are placing their stop losses. Because
Okay.
typically when someone is entering, so I'll just use this for an example here. So say, for example, you're looking to enter a trade here, say like right here, right? We're just going to use this as an example. Typically, if somebody's going to enter a trade here, like this right here is a V1 variation pattern. You can see it's a double body rejection. Typically, what people will do is they'll enter a position here for a buy, right? They'll enter a buy position there. Usually, when they enter a position like that, their stop loss is placed at the swing low, which is going to be right there. So that's why we call it liquidity, because if price comes down, so say, for example, price pushes up, and then usually their stop losses are very high, or their targets are very high. So typically they'll have their trade running like this. And if it comes back down to stop them out, sorry, fix this. So when the trade comes back down to stop them out, when price gets to their stop loss here, it's going to trigger their stop loss, right? And if it triggers their stop loss, the trade has to be offloaded. So they have a buy position here, and when it hits their stop loss, this automatically becomes a sell position. So that's why it's called liquidity, because market is liquid there. When price hits this point, typically what happens is this buy trade turns into a sell trade, and it causes price to drop lower because the market is liquid there. It's like slippery. Does that make sense to you?
I think maybe I'll catch on as we go on. It's not very clear. Yeah. Do you have? I thought liquidity was maybe the highest price when the market started, when the market opened.
No, so that would be, so the highest point, that would just be the swing high. So that's typically the sessions, the session high lows. That's typically what those are called. Those are areas of manipulation. But so a basic explanation of liquidity is because, so when you're trading, there has to be two sides of the trade, right? So if you enter when you enter a buy position, that's why price is climbing. So if you're entering a buy and a lot of people are entering buys, that's what's pushing price up. That's the liquidity that's pushing price to the upside. So liquidity, you're basically identifying where people are having their stop losses. So like I said here, when price goes like this is because people are buying, right? People are buying, price goes up. People are selling, price goes down. People are buying, price goes back up. So what do you think happens so say, for example, everybody enters buys here, and think of this as everybody's stop loss, right? Let me mark a line here. So when price comes back down to this point here where their stop loss is, this is where, so in order for you to get out of their buy, it needs to be a sell, right?
Yes.
So what do you think happens when the sells get hit? Do you think price is just going to stay there? Or do you think price is going to drop because there's more sell orders that are filling right here? Does that make sense?
Yes.
Yeah, so that's how it works. So there's liquidity on both sides. So say for example, price is going up like this, and price comes down. So if price comes down from where it is up here, when it gets to this point here, if there's sell orders here, it's going to apply sell pressure, right? So if there's sell pressure, then of course price is going to drop lower because everybody's entering sells at this point. So
Yes.
that's why it's called liquidity, because when price touches this point, which is liquidity, that's where price will continue to drop lower. And then in the opposite direction, say for example, price doesn't actually touch here, right? Say price comes down here, and then people start to take sells. So if people take sells here, and then price pushes up, what do you think happens if their stop loss gets hit here? Because if they're entering sells, when price touches this point, what happens is buys automatically fill. So say, for example, there's like 100 people looking to buy right here, right? And the buy price touches it. So what do you think happens there? There's going to be buying pressure, because if this line gets hit, basically X amount of orders are going to get filled, and it's going to push price higher, because there's going to be, instead of being 10 buyers, there's now 100 buyers, because this level right here has been touched.
Yes. Okay.
Yeah.
Okay.
Yeah.
Yes.
So that's kind of like the explanation of like liquidity. I know it sounds a little more complicated, but it's really simple. It's just liquidity is where orders are sitting. So when those orders touch that specific price point, you're expecting price to push up higher, and you can kind of see it. I mean, you can see it better on, like, say, the 1 minute time frame. Like, let's see. I think this will be a better example for you, so I can show you how liquidity works in real time. Okay, so I think, okay, we'll do this right here. So looking at this right here, we would consider these levels right here liquidity. So this is basically where people are entering. When they enter buy positions, this is where they're going to be placing their stop loss. So say, for example, you enter a buy position right here. Generally, where people place their stop loss is going to be slightly below it, like right here. So what happens, this means that there's pending sell orders here. So in order for you to get stopped out, you have a pending sell order, because you enter a buy position. If it goes to your stop loss, it puts in a sell position and it automatically liquidates you. And that, again, that's where the word liquidity comes from, because it liquidates the position. So for example, here you're waiting for price to come back down, and if price comes down and hits this, you would expect price to drop even lower, right? So if we go forward here, see how price is getting close to it? See how this big candle comes out of nowhere?
Yeah.
Because they're getting liquidated. That's why it's called liquidity. So the buy positions here got liquidated, basically.
Okay.
Yeah.
Okay. Okay.
It'll
Yeah.
make more sense with time. I mean, once you look for it and you know what you're looking for, it'll start to make more sense. But yeah, liquidity is it's literally what it's called. Liquidity is just price orders getting liquidated, and it causes price to move a bit more volatile. And that's why you have like big candles here that kind of move. You can see how it just drops lower.
Yeah.
Yeah.
Okay. Thank you so much. So I'm done. So I'll leave the floor to Miriam and Fumi now. Thank you,
Okay.
Sean.
Yeah, no problem, Marion. So yeah, guys, if there's anything, I know Marion said that there was you guys wanted to see some examples. So which examples did you guys want to see, so I can pull it up? Unless you guys have a specific entry. If you have a timestamp, we can pull up a timestamp. Otherwise,
Hi, Sean.
Hey, Mariam.
We don't, and I don't have a specific timestamp. I was talking to Fumi before the session, and we thought that we should go over yesterday and today.
Yeah.
I'll tell you what the specific questions are. The liquidity push example you gave has clarified so much. I had been looking at it in a different way, but I guess I'll have questions when we look at yesterday and today's charts. One of my questions though is, I have a split screen. Remember the last time we set up my account, I had like 2 screens split. So I had my 10-minute on one screen and I had my 1 minute on the other screen, so I can see them at the same time. Now, what I found is that a lot of times when we have hit our stop loss on the trades that we've taken, it's typically around sessions. So and remember, I remember asking a class a couple of months ago why we were taking those trades around the session, because I know one of the very first rules you drummed into our heads was trading around sessions with a red flag. And so I kind of had in my head most trades around. But I realized that when we were doing the PRB and a couple of the new strategies, we were taking trades around sessions and it was hitting stop loss. And then this last explanation you gave on the liquidity push, the resistance or the support levels, I would think also going back to the very first rules you gave us in terms of red flags, those would have been red flag areas as well, not to trade. So at what
Hey, Marion, I think you might have gotten muted or your mic stopped working. You got cut off.
point would we be able to take the trade, take those liquidity pushes? But I'm always a big kind of like, am I supposed to be doing this? Is this not a red flag to get the trade around this one? Because the trade can, it usually would test the area and it either bounces and, goes reverses or it continues through.
Yeah, no, I agree. So yeah, the strategies were slightly different when you're applying the PRB and the breakout V3. Those didn't incorporate the red flags, but that's one of the mistakes that I started to realize, obviously moving forward with our VV3s, because typically with the breakouts, we would just ignore the red flags, but they should have been taken into consideration, because basically all of the losses that have happened were based off trades that were touching the red flags or
exactly.
Yeah, exactly. So now that we're going back to our original way of trading, yeah, the red flags are always important. We were just the win streak kind of just overlooked the stuff that we typically look for. But now that we've been going down, a bit of a losing streak with the breakout V3, it's been more and more apparent that we should be focusing on the red flags. So yes, you are on the right path, and you are correct with us taking into consideration support and resistance, red flags, with regard to the sessions, opening price, news price. And I think, yeah, it's something that should always be factored in when you're making a decision about a trade.
Okay, I'm clearer now. Now, on the liquidity push, which you just explained, it seemed pretty interesting. And for me, because like I said, a lot of people in class, I find, take those liquidity pushes, even when you don't take those trades. And a lot of them, win those trades. They don't lose those trades. Now, are they still checking off all the rules, as in the trend? They're looking at the trend, they're looking at the momentum, they're looking at the candles and making sure it's not at a session and taking those trades? Or because we're taking smaller pips of just 10, we're safe?
Yeah, so everybody does it slightly differently. So I've talked to people who take the liquidity push. I don't really like the liquidity push that much, because I think it's very risky, because the way that the strategy works, it doesn't factor in those red flags and stuff that we just talked about. So with certain people, like I know there's a couple people who just take every liquidity that goes through. If you looked at the liquidity from today, they actually did play out. I think one of them touched, but it didn't finish. And some other people, so there's one person who takes every entry. There's another person in our group. He waits for it to touch, I think 3 times. So he waits 3 times. He looks for it to touch once, push away, touch again, and then on the 3rd time, that's when he'll enter the trade. So everybody has their own specific way that they like to take the liquidity. The way that you're supposed to take it is you're supposed to take it right away. So you're not supposed to factor in the trend. You're not factoring momentum. Those are going to be confluences. So if you have those, odds of it hitting are more likely than not. But the way to just take it normally would just be in both directions. So like using, let's go to earlier today. So like say for example, let's go to 7 o'clock. So you'll see like some people, so the original way of applying liquidity is marking up liquidity on both sides, like on every side, basically. So this is how the original way of taking liquidity is. They just mark up every level that has not been tested yet. And some people apply it this way, but like you said, for me personally, I like to have other factors. Like I like to know, I like to be trading in the direction of the trend. I like to be trading in the direction of momentum. But this is like the original way of applying the liquidity that some people apply. So like, for example, here, this is the level of liquidity right here, right, which would get hit. So this is one level there. There's another level right below right here. And this one doesn't get hit. And this is where it comes into play, because if you turn on the sessions, I think there was or there was something down. I think this was the support level that we marked up on the thing over here, because it was in the 1 hour support, or the 4 hour support, when you marked it up over here on the clean chart. So there's different ways of applying it. You can take it in both directions. And you
Are
can,
you talking about your liquidity on the one? Are you talking about the liquidity on the 1 hour or the 1 minute?
well, if you're applying, so it depends on your question. So if you're asking, because you're asking about the regular liquidity, the regular liquidity is every level.
Yes.
Yeah, so that's the regular liquidity, but the liquidity that I mark up for live sessions, we don't go down to the 1 minute. We only go down to the 10 minute. So we go from the daily down to the 10 minute. So I mean, depends on your question. If your question is because liquidity is different, so you can do.
I'm wondering what time limit is this chart? This current
is-
chart is on what time limit?
This is the 1 minute. So you'll see the time frame right here. This is the 1
Yeah,
minute.
I thought so too. That's why I was wondering why we marked it on a 1 minute and not the 10 minutes. So that's why I asked that question, because I thought this is a 1 minute chart. You mark
Yeah.
it on chart?
Yeah, so typically I wouldn't mark
Okay.
it on here. This is just how the strategy normally is. Like depending on your question, if you want to see how it's originally applied, this is the original way of applying it. But typically it's not drawn on that point. So if you were to draw it like how we would normally, you would go from the daily time frame. This is how I mark it up. So let's just do it how I regularly do it. So here is the daily
Okay.
time. And then from the daily, we go down to the 8 hour.
Okay.
And from the 8 hour, we go down to the 4 hour. And from the 4 hour, you go down to the 2 hour. 2 hour, we go down to the 1 hour. And there's no specific time frames that you can use. You're just going down from like the higher time frames. So you can pretty much go down to, whatever time frame you like, but the lowest time frame you'll go down to would be the
10 minute.
10 minute. Yes, exactly.
Okay.
So we go down there and go down to the 15. Go down to the 10 minute. And it looks like that is about it. So we've marked up liquidity right there. Now we go back down to the 1 minute. And there's where you'll start looking for entries of liquidity. So from this point right here, or actually, let me see the time frame. I thought we were at 6:30, but for some reason it went all the way back. Oh, it's weird. Yeah, let me go back. Let me do it again one time. I'll do it quicker. Yeah, I'm not sure why I did that. All right, here, I'll do it real quick. So let me just refresh this. Daily time frame down to the 8 hour, down to the 4 hour, down to the 2 hour, down to the 1 hour, down to the 30 minute, down to the 15 minute, down to the 10 minute, and that's it. Okay. I don't know why it keeps doing that. So it keeps reverting back to market now, but I mean, I don't know. I think because the market's not closed, it's not letting me go back in time. But basically, that's how you would mark up liquidity. I don't think this is going to move forward. Yeah. See, I don't know what's going on with the chart because I mark it up at 6:30, but then it goes to. Yeah, let me do it one more time. I'm going to refresh the chart this time, so maybe it doesn't reset the time. Okay, so let's go over here. I'll go to 6:30 again. All right, let's replay 6:30. I'm gonna go on the daily again. Let me go back to the 1 minute. I'll see if it messes up. Okay, it looks fine. Daily.
So I'm sorry, are you just marking the higher lows and the lower lows? Are those the liquidity levels? Or how do you know what points to mark?
It's all of the high lows that have not been tested. So you can see these price points. Price has not come back to touch the point yet. So it doesn't matter if it's a higher high or a lower low. I'm marking at every high low because since it hasn't been tested yet, that just means that price, when it touches that point, there's probably going to be liquidity waiting there. So yeah. So basically all of you can see like these over here. I'm not marking these because price has already touched these points. So these here are relevant, but these over here, they have not been touched yet. So everything that has not been touched, that's where I'm marking the liquidity. So basically all like these right here, I won't mark this because price already has touched it. This right here, price hasn't touched it, so I'm gonna mark that as liquidity. So go down to the 15-minute. Go down to the 10-minute. And I think that's it. Okay, I don't know. Sorry, guys. I can't give you guys an example of liquidity because every time I go back, it just goes to current time. There's no way that it'll let me. Here, let me do a different day. So I'm not going to do today's because it's not working.
Okay, that's fine.
Yeah, let's go to Thursday because it keeps reverting back to the current time. And I can't show you the examples because the liquidity's already been touched. So let's go over here to Thursday. I'm not sure. I've never seen that happen before. I don't know if it might be because the market is closed for the weekend, but let's try this one more time. Let's go to Thursday. Let me mark up liquidity here again. Same thing. Going down to the 8-hour time frame. Going down to the 4-hour. Going to the 2-hour. Down to the 1-hour. And you don't really have to mark up like these levels that are up here that are so high because price is not likely to touch those points. But I typically just mark it up just so that we have a visualization of like where price can go if it ends up going that far. But realistically, it's not going to get this high, not in one day. It's such a far move. All right, so we've marked that up here. Let's go down to the 1 minute. Okay, so this one actually works. So this is how liquidity would be marked up every morning before we go live. So we have like the levels up here and then the level down here. So typically there's going to be two levels that are closest to current price. And this is usually what it looks like. So look, when liquidity touches it, depending on like the person who's applying the strategy typically is supposed to be taken right away. So right when it touches here, that's usually where the liquidity is taken. But for certain people in the group, they wait for a second touch. So like this right here would probably be avoided because this is the opening candle. And typically what people will do is they'll wait for it to get touched again before they look to take entry. Usually you don't want to take liquidity on the first opening candle because you can see how this candle here was very manipulated. It shot up, it shot down, and then ended up right in the middle. So basically you're just waiting for price to come back and touch those points. I don't think liquidity was touched throughout the entire session until like closer to the end right here. Okay. So this is the first liquidity entry that came up during the live session yesterday. And I think a lot of people in the group took this trade here. Liquidity was sitting right here at 38,540. And basically what you're looking for here, you're looking for price to touch it. And what a lot of people do is they put a pending order there. So they'll just put an order just sitting there, waiting for it to be touched, which would be a sell order. And then the TP stop loss is sent to 1030, like that's there. So as soon as price comes down and touches it, you can see at this point, the entry is now active. And you can see right here, price goes through and it hits the full TP right there. So that's going to be one level of liquidity right there that's gotten hit. And the next level is going to be down here. So it just depends on how you want to apply it. You can see right here that it touches it once, but it doesn't always go straight to full TP. And this is why some other people will wait for the second or third touch. So if you wait here, you know, if you didn't get in right away and you waited for it to get touched again, you can see right here, price pushes up and then it comes back down. So this would be the second touch and this right here would be the third touch. So it just depends on the person. Some people want to wait for the one touch. Some people wait for two touches. Some people wait for three touches. It's just up to the person because that's how their brain works. They don't want to get in right away because they're scared or they're nervous and they just wait for another opportunity to enter the trade later. So there goes the first level there. There's another level below here. So you can see again right here is another level of liquidity. So it has not been filled yet, still pending. Still pending there. Still pending here, has not touched it yet. Still pending, has not touched it. And you can see here, eventually it's getting closer and closer to it. And then now when it finally pushes through, you can see that it's now active. And you can see here, this is why people wait for the second or third touch. So there's one person in the group who he mainly takes this strategy. You'll see here that if you took it right away, you would have lost this trade. But what he does is he waits for it to touch about 3 times. So he looks for it to touch, retrace, touch second time, and then now he's waiting for it to come back down. So on the third touch, that's when he would take it. So it comes back down again right here. Or eventually, I think it comes back down. Takes a long time. This was the market from Thursday. The market was going sideways. This strategy is not really good for a sideways market. This strategy is meant when, you know, the market keeps going in one direction. So I think this eventually comes back down where it might not. Yeah, I don't think the price ever came down because it was just going sideways for the entire day.
Yeah, by this time you've hit your stop loss anyway.
What was that for the thing?
I said by this time you would have hit your stop loss.
Well, if you got in on the first touch, yeah, but if you were going in for the third touch, you would have never filled it. That's why he waits for the third touch.
Okay.
Yeah. So, you know, if you wait for multiple touches, then you would just be waiting for it to come back down. But in a lot of instances, if it doesn't come back down a third time, then it would never enter the trade. But for this one here, for this one here, you would have gotten it because it would have touched once, retrace, touch second, retrace, and then third time.
Yeah.
And that's what would hit. So it depends on the person. For me personally, I don't like applying the strategy because for this specific reason, you know, you might get caught in a fake out like this because the liquidity zones are considered like areas of manipulation too. You know, when you take a trade like you have a chance of it hitting, you have a chance of it not hitting. So it's like it's a big risk that you're taking when you trade at these price points because a lot of people are trading at those price points. They're looking for the same thing. So it's kind of dependent on you. So for me, sorry, go ahead. Oh, no, I was going to say for me personally, I wouldn't take it because that's why I never take this entry. But if you wanted to take it, you know, it's probably better to wait for a multiple touch.
Well, when I take mine, I usually take it on the third touch, and I kind of have labeled that a confluence, as in it's in a, I can see the trend has been established, the momentum has come up, and it's done it 3 times, and then I'm almost certain I'll just go ahead and take it because I think it's ticked all my boxes.
Yeah, exactly. So that's one thing that I would personally do too. So like if you're looking for liquidity, I would only take it if like things line up, like if the trend is in that direction, and then also if the momentum it has already been established. So for example, like this right here, there's momentum that's active. If let me go back over here. So if I have momentum active like this and price comes down to this point, if it was to ever touch this area down here, then that's when I would take it. Because you already know the trend is down and you know the momentum's coming down. But if you have an opposite momentum, so say for example, you have a buy signal, at this point I'm like, okay, I wouldn't take a trade like that. Because you know it's not going with my confluences. Like I want everything to point in this direction. So whenever I'm looking for a trade, I'll typically look for reasons not to take it. So every time I look for something or if there's an entry, I'm going to look for reasons why it's not a good trade, because odds are, you know, those reasons are probably correct. So like you said, if it doesn't line up with your boxes being checked off, then you just don't take it. So that's typically how I would apply it. But yeah, the market on Thursday, well, this is already after 8 o'clock. So, you know, when you trade after 8 o'clock, you'll see the market just go sideways. That's why I don't trade after 8, because you can see over here between 8 and 9 o'clock, price kind of just goes nowhere. It goes sideways for a bit before it starts to you know, finally move directional here. Once it gets closer to around 10 o'clock. Yeah, so you can see over here, the market's kind of just going sideways. And then around 10 o'clock, the market starts to finally climb back up.
Okay, another thing I noticed is today, in fact, right before we started this session, the ATR was pretty high, but the market was still going sideways.
Yeah. So the ATR was high because it's so the way that the ATR works is that it gives you an average of the previous 15 candles. So the market was actually volatile earlier before the session because of the news. So if we go back over here, let me see where's the
Okay.
Yeah, so if you go over here to 6:30. So the ATR here was like at 17 pre-market, right? And then you can see here it picks up. It picks up because these previous candles here, what it does is it gives you the average. So the way that this ATR is set up is it gives you the average of the previous 14 candles. So basically what it does is it'll give you the average. So this is the average of like, say, you know, the previous 14 candles. It's 87 points. Basically all these candles, if they were all added up and then divided by 14, it would give you the average, which is the ATR 30. So that's why the ATR is useful, because it shows you what's happening within the past 14 minutes. It doesn't necessarily tell you what the market's doing like previously to that, but you can see how big the range is right here, right? The market's moving very volatile.
Yeah. I did notice that the candles were also pretty big.
Exactly. So the ATR will give you the number of like the previous candles. So like the market will go, it'll move very, very volatile. And then eventually the market will just, and you can see here, it's still moving volatile. But yeah, eventually the market starts to go sideways. So now here it's going sideways, but it's still factoring in, you know, these previous big candles over here. That's why the ATR is high. And then you can see here the ATR starts to get a little bit lower, because now it's going sideways. Now it's going sideways. It went from 30 ATR to now 20 ATR. And then you can see it just drops down completely. It goes from like 30 ATR to 20 ATR to now 15. Because these candles are a lot smaller. So now the average of these candles right here are only like 15 points. And that's how you can know if it's like actually consolidating, or if it's just, because sometimes you'll get random candles. Like this will be like the big candle, right? Before that, you can see the ATR was actually very low. It's at 17. And then you have a couple big candles here, big candle, big candle. Now the ATR is back to 19. So
one of the questions I wrote down, which I didn't ask, is what's the implication of the size of a candle on your trade? Do you hold back from trading if the candle is too big?
yes, that's correct. So that would be one of the red flags. So the red flags that I have here, let me see if I can pull them up. So if you look at the red flag list, it's when price is near sessions, price is near opening price, basically any of the horizontal lines. Other than that, it's when the candle prior to entry is too large. The reason why we avoid candles when they're too large. So for example, right here, I don't think there was an entry here, but let me see. Yeah, so there's no entry here, but this right here would typically be avoided because, so say for example, this is your entry, right? Just say, for example, there's some sort of entry here. The reason why you would want to avoid this is because when you get a big candle like this, typically the candles will push up to retrace because it's pushed down too far. So it has to retrace.
I see.
And before the retracement or after the retracement, it might come back down to hit your TP. But the way that I measure this is when I put the TP stop loss, if the stop loss is smaller than the candle, then I'll avoid it because you'll see here, see how price now goes back up because it has to retrace. It's too heavy of a candle where it needs to retrace. So that's why we avoid it when the candle is too big prior to entry. If you ever get a candle like that, it's not always going to happen, but for the most part, when we do see big candles like that, so let me show you another example over here. This is an example of it retracing, but not exactly the full amount. So again, right here, another big candle. If we put a sell entry right here, and we do the same thing, you can see again right here, this candle is too big. So I wouldn't take the trade here. And you'll see here that price sometimes will hit profit target right away, or sometimes it'll retrace up. And you can see how it retraces up right here.
Yeah.
And then it comes back down, right? Because whenever there's a big move like that, there has to be some sort of exhaustion. So price comes down, some exhaustion here where price comes back up, and then eventually comes back down. Sometimes it only comes back half of the candle or partial. Sometimes it goes higher than the candle. But you don't want to be put at that risk because when you take a risk like that, you're kind of gambling. Because the thing is you already know that it's probably going to retrace, right?
Yeah.
So realistically, it's like, why would you take that risk when you understand there's a risk there? You want to take a trade that's risk-free. So you know for sure it's going to work out properly. So here's another example over here where you can see there's some sort of big candle right here, but it's not that big. So there's a V1 variation right here. This is a V1 variation. It's also considered a consolidating variation. We'll do this again right here and we'll put a TP stop loss. So as long as your stop loss is bigger than the candle, right? So the stop loss right here is bigger than the candle. You're going to be okay with it because you know there's no risk here. Odds of this pushing down are very likely. Odds of it pushing up is very unlikely. So if you take this entry here.
And this is a 1030 TP stop loss.
Yes, 1030 TP stop loss.
Okay.
Yeah. Well, yeah, it depends. So like the market's been kind of slow with the consolidation in the market. So we've been using a 1025, but it's not a big difference. So this is typically what we'd use a 1025, but if you put a 1030 next to it, it's like just a little bigger.
Mm-hmm.
So it's not like a big difference.
Mm-hmm.
And we just change it based off of ATR. If ATR is high, then we'll change it. But I think 25 is okay, just to minimize your risk a little more.
Mm-hmm. Sean, could you go back to the chart that we had on before, the one where we were looking at the momentum push with the big candle, just the one just before we got to this one?
Oh yeah. Let me go back to that one.
Okay, so I have a question on that one.
It was.
I think, yeah, okay.
Was it?
Is it this one? No, keep going.
Yeah, it's a little farther down. It was like a big red. Oh, there you go. Okay. This one right here, right?
Yes, this one. Okay, my question here is, couldn't we have taken a sell trade because if we draw up our liquidity areas, we would mark up the high low and then the lower low. That's before this huge red candle. And couldn't I have taken a sell then and it would have hit my TP?
Yeah. So if you were to draw liquidity here,
Yes.
so typically the way that you would draw liquidity on the 1 minute is you're looking for reversal. So like you said, this would be liquidity right here. This would be
Mhm.
liquidity here. This would be liquidity right there, right?
Yes.
That's all the liquidity. So what you're looking for is you're looking for reversal. There's another liquidity right here too. So you're looking for reversal. So yeah, if you wanted to take liquidity here in the opposite direction, your entry would happen right there. And then you can have multiple entries if you want. Like you have one there, you have one there, you have one there, and then you have another one down here. So when price comes back down, and this is a perfect example of liquidity, because you can see how price is going sideways, but eventually when it touches this point, you'll see when it touches liquidity. See at this point now liquidity has been triggered. So this is called a stop loss hunt, because now they're hunting all the stop losses. You can see here that
Okay.
it's hit. So that's the first TP right there for the first liquidity. And see how this big candle comes in? That's what I mean about liquidity, because once there's enough sellers in the market, then it pushes price very heavy like that.
Mhm.
Yeah, so you can
Yeah.
see how that happens. That's why we call it liquidity, because when price touches this point, the market becomes liquid. Because you can see over here, the market's not liquid prior, right? The market right here is going sideways. There's no liquidity here because price is just going, it's just going sideways. And then eventually, once the level gets triggered, this level, see now it's triggered. At this point, when price drops lower, there's going to be selling pressure. And that's why we call it liquidity, because now market is now liquid and we can expect it to drop down a lot heavier. That's where this comes down. And that's where we call it a stop loss hunt, because the stop losses are now getting hunted to the sell side. But yeah, because the market, you can see here, the market, it's going to swing both ways. It's not always just going to go one direction. So you can see price goes down. And you can see over here too, if you want it to go the opposite direction, you can see over here that there is even liquidity on this side. So if we go and rewind to this right here, you'll see that there's also liquidity over here too on the higher side. So price goes down a little. And then you can see when price finally goes up, it does the same thing, but in the opposite direction. So we're in a downward trend here. Price now reverses. There goes the first level of liquidity right there. And then now you have all these other levels that should be hit
Now,
also.
I would not have taken the buy, even though there was a liquidity on top, because of the pivot, the red pivot on the top.
Yeah,
That would have been,
yeah, you would have waited for the trend to shift first, right?
yes.
Yeah, because you can see right here, the liquidity still gets hit, but it's tricky because of the trend. Because you're
Yeah,
going,
but I can see that it's shifting. Yeah.
yeah, and then what you would do here is you look for the correction. So price is pushing up here, and then you already know that. So if you zoom out, you'll see, okay, price has been bearish all day, right? So that's how you have a bias. So if you know price is bearish, then you would just look for liquidity, on the bottom side, because price is coming down, and the odds of it coming down even more are very likely, right? So you just have that there. And if you know price is coming down, then you just mark up all of the liquidity right here, so that when the correction happens, you're already ready for it.
Yeah.
So again, right there, you just move the liquidity. And then now when price finally comes down, you will have the opportunity to catch the correction. And there goes the correction right there as it drops down lower, right? Yeah. So yeah, this is why we do it on the bigger picture. So like when I mark up liquidity, I typically go on the higher time frames, because you're going to see where liquidity is actually sitting, and you'll know which direction to be trading in. Because you'll see here when it fills this whole area that you already knew was going to happen, since you already have a bigger picture of how the market was moving. Because it typically follows. Like if you really want to see how the market's moving, what I would recommend, like if you want to have some sort of bias with regard to the trend, I would probably mark up like 12 o'clock, 12, which is London Open, because wherever market goes from London Open, that's typically where market's going to keep going. So for example, here, if I was to trade and say, for example, you wanted to mark up something like, say, pre-market movement, you just look here from London Open, you'll see price went sideways for a bit, but then it ends up coming down further, right? So with price coming down further like this, you can anticipate that when New York session opens, it might come up a little bit, but it's going to
going down.
It'll come back down. Yeah, it'll correct back down to where it's supposed to go.
Yeah.
So yeah, if you want to look at liquidity, I would probably look back to London session, see how the market was moving, and then only mark up liquidity on that side, like for the sell side, because that's going to give you a better understanding, and you have some sort of bias where to trade. Because if you're trading both directions, it's very risky, right? Because you're kind of. But if you have a bias and you already know, okay, I'm only looking for sells today, then the liquidity makes sense. Yeah. So it's yeah, so it's a little I mean, you have to practice it a lot more, but the more and more that you practice it, the more and more it'll make sense. There's just a lot of different ways to apply liquidity, because liquidity works in both directions. You just have to kind of figure out which way that you want to be focusing on.
Okay.
Okay, please. I struggle between knowing the difference between the V3 continuation and the V3. They're both breakouts, I know, but one is continuation, the other is just a breakout. What's the difference between the two?
So it'd be the breakout V3 and the consolidating breakout, or no, the consolidating variation is different. For the breakout V3, you're looking for a momentum candle, and you're looking for a following green candle. So for example, this would be an example of a breakout V3 continuation, right? A buy signal, and then you have a green candle after. This here is a breakout V3 or breakout V3 continuation. It depends on what you're applying. Same with this right here. There's another example here. It's a sell signal, and there's a red candle that follows. So you're just looking for two matching candles. You're looking for a sell signal and then a red candle. If you have that, that's going to be another breakout V3. The consolidating breakout is completely different. So it's completely different.
The continuation breakout, is it the same? There's the continuation one, and then there's the one that is just the breakout.
Oh yeah. So for the breakout V3, the actual breakout, there's only one entry a day. So for the breakout V3, you're looking for only one entry per day between 6:30 and 8. That's going to be just the regular breakout V3. For the breakout V3 continuation, that one can happen all throughout the day. So you can take that all day. So the difference with that is a TP stop loss. So if you're looking for the breakout V3, just the regular breakout V3, it happens once a day. You're looking for an entry that happens between 6:30 and 8 o'clock. And for this one, you're using a confluence. So you're using a V1 variation. You're looking for a double body or double wick. I don't think there was one today. Yeah, so there wasn't one that came up today here. Trying to see if I could find one. Yeah, so there's no entry that came up today during the live session. I mean, there was a breakout V3 continuation right here. The continuation is different because the regular breakout is 25.25 for TP stop loss, and the continuation is 10.30 or 10.25, depending on like what you want to use for that specific entry. The continuation is it just happens throughout the day, and you can take as many as you like. Like for example, there's one that happens here. There's I think there's more that happened later in the session. Another one right here. Not there. Another one right there, and you can see they come up a lot of times, but you're only going for 10 points. So regular entries like that, 10 points. Something like this right here, same thing, 10 points. Same thing with this one over here, only 10 points. That's for the continuation. For the regular breakout, you're going to be going for the 25.25.
Sorry, Sean. This one here, this this entry here, did it hit the stop loss? Not the far right, the one just before the one, that one, yes.
Yeah. So this one I wouldn't take it because it was after 8 o'clock. This is when the market goes sideways. Yeah, so typically, typically like, once it hits 8 o'clock, I don't trade because the market goes sideways. This strategy is meant for it's meant for directional market. So the markets typically should be going up or it should be going down. Because you're basically riding them. But like from 8 o'clock, between 8 o'clock and 10, this is usually a time where you shouldn't be trading because you'll see from the ATR that the market gets really, really slow. So I think the entry happened right here, right? The one that we looked at, that loss. And the thing with the breakout B3 continuation is that you have to factor in the red flags. So the red flags over here, put up the red flags again. So for the red flags, let me see if there's the sessions down here. So I don't have the news marked up. I don't know if there was news that was happening down here, but I mean, either way, it was after 8 o'clock. So you don't want to trade around the sessions, opening price, news price, when candle prior to entry is too large, and then also when price is ranging or consolidating. So this is after 8 o'clock. This is when the market starts to consolidate a little bit. And if you want to make sure if the market's consolidating or not, you can always mark up where the higher high and the lower low is. So for example, the higher high is right here. You can draw a box. And you can see the lower lows right here, and you can draw a box. So if you're to turn it off, you'll see here it's pretty clear that the market is consolidating right here, right?
Yep.
So that's why you would have avoided this trade here because it's just it falls within the red flags that you want to avoid when price is ranging or consolidating, because you want price to be moving directional. So you want it to be going up, or you want it to be going down. So for example, over here, you'll see that, price was trending down right here. So this is going to be one that you would actually take.
Yeah.
Right? This one's actually moving directional. And then, so right here, sell signal, red candle. At this point, you have it set up 1030. And that one right there, it works. Because it's moving in a direction. So I know it gets kind of confusing because sometimes you're not paying attention to like if market's consolidating, but I think the big giveaway here was at the fact that the entry came up after 8 o'clock. That's usually the cutoff. Even for me personally, I stopped trading around like 7:40. So for me, the cutoff isn't even 8 o'clock, it's 7:40. And you can see over here at 7:40, this is where the consolidation actually started.
Yeah.
Yeah, so I know there's like a lot of little things to kind of factor in when you're thinking about taking an entry. But if you just follow kind of what I'm doing, like where I stopped trading, and this all comes from experience, right? The reason why I stopped trading between 7:40 and 8, or like that's usually where I cut off, is because when I looked at my spreadsheet here, I look at the trades from 2023. I'm like, okay, when do I lose trades? And it always happens later, like 7:40, 7:46. So of course, for me to avoid those losses, I just don't trade at those times anymore. So I just get better and I just avoid losses that could be, easily avoided. Yeah. So is there anything else you guys want to cover?
Nothing. The only thing is my ATR isn't showing on my chart, but I know I don't know how to set it up to show.
Oh yeah, so Marion, so make sure that you have the K2 trailing stop indicator on. So you go to your indicators, invite only tab over here, and it's going to be the K2 trailing stop. Once you have the K2 trailing stop indicator on, you'll go into the settings here. It might have lines on here. This is how the default settings are, where you might have lines up. You just need to turn them off. So basically you go to your settings, you can turn off this trailing stop, and then you go to inputs here, and then you click on show ATR. So down there on the bottom, it has my ATR. I turned it off. If you turn it on right there, it'll show up. And then you can set where you want it to. So you can have it at bottom center, bottom right down here, top right, top center. It's up to preference. For me personally, I think it's easier to see on the bottom center.
Yes.
That's where I have it set to. And then
Okay, thank you.
once you have that, it's pretty much good to go.
Okay, thank you. Thank you very much.
Yeah, no
Thank
problem.
you.
Hopefully it answered a lot of your questions. I know there's a lot of little things that might come up. Yeah, I'll try to make it as clear as possible.
Yeah. Thank you, Miriam and
Thank
Fumi.
you so much, Sean. Thank you.
Thank you, Sean.
Thank you so much,
Sure.
Sean.
No problem.
Thank you.
Yeah, if you guys have any more questions, let me know. If you guys want to set up another meeting in the future, just let me know and we'll do this again.
Fantastic. Thank you so much.
Yeah.
Thanks.
No worries,
Thank
guys.
you. Enjoy
Good
your
night,
weekend.
everyone.
Thanks for letting us piggyback on this.
Definitely. All right, guys, have a great
Thank you so
weekend. I'll
much,
see you
Sean.
guys.